Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So what you're trying to do is, if you combine these three different pieces of the outlook into one, and then you make a decision about what option strategy you're going to choose, you've really reduced the possibilities down to a few choices, and it's much more manageable. I mean, there's over 50 option strategies that you could work with. I mean, that's quite a lot of choices, and part of the problem, especially with new traders, is they have so many choices they really just don't know where to begin. And if you can take these three aspects and understand them and understand what the strategies are trying to accomplish, you can figure out which ones to eliminate very, very quickly. And so you're taking 50 strategies down to 2 or 3, and that's a much easier decision to make when you're just getting started or at any level of this game. So to give you an idea what we're talking about here, to go back from before, we said in the lower third you might have strategies like buy a call, buy or put, buy a straddle. Well, if I'm bullish, right, I'm not going to buy a put and I'm not going to buy a straddle because those strategies don't accomplish bullishness. They don't work with bullishness in an efficient manner. I know this may sound simplistic. I mean, most of us probably know that buying a call is bullish and buying a put is bearish, but I think you're getting the idea here that when you start to break it down, the number of choices becomes much, much less. If you're bullish, or rather, let's say if you're bearish and volatility is in the middle third, well, then you might consider buying a put vertical or a bear put spread. You might a long put spread. All these terms mean the same thing. A put debit spread. You might consider something like that. You know, you're saying it's in the middle, but so you're not really sure what volatility is doing, but you still want to make a trade and you're bearish, and that might be one solution. And then finally, let's say you're bullish and volatility is on the high side. Well, maybe you decide to sell an out-of-the-money put spread. You know, a bull put spread, a selling bull credit spread. All these terms mean the same thing. Oh. All right, and then these are some points that I borrowed from Steve. I hope you don't mind, Steve.
Not at all, Nicole.
I figure it can't hurt to remind people of some things that they should be aware of. So that part 3 of the outlook, when we're talking about FX options, we're talking about, like I said, what's going on in these other countries. Do they have really high rates of unemployment? You know, is there a lot of political unrest that maybe could pull the country apart and make it nearly impossible for the country to engage in trade and so on? I mean, there's a lot of things to consider here, and that should really be part of your final decision-making process. So just to summarize, the 3 things that you really want to focus on is an outlook on implied volatility, an outlook on the spot currency, and an outlook on the events that those countries that are affecting the countries involved in that spot relationship. And just put these things together and choose the best trade that you can. That does it for me for my presentation. You know, I'll be happy to take any questions while we're waiting for that to come in. I just wanted to let everyone know what events we have coming up at TradeKing. And you can access these at webinars.tradeking.com. And we have Price Heedley tonight from Big Trends. Dan Sheridan talking about gamma scalping, trade like a market maker next week. The week after that, June 16th, we have Brian Overby talking about the VIX. We have also Dr. Margaret Smoller on June 23rd covering fundamental analysis. And then I will be hosting the Rookies Corner, talking specifically about contingent orders the last Thursday of the month. So if anyone has any questions, I'd be happy to address them. If you have any questions about TradeKing's website or anything like that, I can also go through a few things as well.
Nicole, I have a question for you, and it's just a question that I get very, very often, whether I'm teaching an ISE seminar or an Option Industry Council seminar, and people often get confused. So here's my question. If you go to any implied volatility versus the historic volatility, why can't I just arbitrage those two distinct calculations, since one is looking at the implied and one is, of course, the historical? Aren't they going to revert, some very quickly so that I can arbitrage that situation?
I mean, I know you've seen this, Steve, where for one of the things about arbitraging is that you need the relationship to come back to something you expect it to, and quite frankly, sometimes that just doesn't exist. You could have, I know of equities in particular where the implied volatility level is always higher than the historical volatility level. The other thing is the historical volatility is about trading the stock, right? You can't trade the volatility of the stock. You can only trade the stock itself. You can trade the volatility in options because they're a derivative of the underlying, but you're talking about, I guess I see it as kind of an apples and oranges thing, even though they're related. They're both fruit.
Very good. That's a great way to put it. I've never heard that answer, although I like it. I think early in my trading career I tried to do that because I think I read some books on it, and I was never successful. Like you said, you just don't know when. So it's nice to know that they're both fruit, but apples aren't going to taste like oranges. That's a great way to describe it.
When I first started out, I also was looking at the relationship between historical and implied, and I think that at some point that was maybe a more valid strategy than it was when I started trading, which was in '99. Everybody says, oh, things are so crazy, the market's so crazy. I'm sure the market was crazy before I was trading it, but the mentors that I had, I think that the historical versus implied strategy was something that maybe worked for them on some levels, but it seemed to become less relevant the more and more trading I did.
That's a great point. That's a great point. We could talk hours and hours about that because Nicole and I have a lot of stories about different trading. But that's a different, really topic for a different day. There's an attendee that's saying, are the TradeKing webinars free for everyone? Let's say that somebody wants to go over and listen to Price Heedley right after this. Nicole, can they do that?
Oh, of course. You don't need to be a TradeKing client. It's open to anyone, and of course they are free.
That's great. And you have a great group there. Price has been with us, and if you guys are free at 6 o'clock, of course we'll be done by then. I would recommend it because Price is really good. He looks at trends, so if you're interested, that's the name of his company, Big Trends. Go and check it out.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.